Well, good morning and welcome to WG Hub Live. As part of our series on strategies to cope with COVID and beyond, we're focusing today on the impact of the Brexit trade talks on the complex area of VAT and duties. To help us through the minefield, I'm delighted to introduce Tamara Habberley, Senior VAT Consultant at the VAT People. Welcome to WG Hub Live, Tamara.
Thank you.
And it's great to have you here. We're also very pleased that Ernie Batty, Director of Medicare Systems, is able to join us on the panel this morning to offer up some practical issues and commentary on how SMEs are feeling about the current situation. Good morning, Ernie, and thanks for joining us.
Good morning. Sorry that I'm sort of in the shade and dark. My PC blew up this morning, so I'm on somebody else's.
Well, thank you very much for making the effort, Ernie. I really appreciate it. A very warm welcome to obviously all our regulars and to those joining our audience for the first time. Normal WG Hub Live rules apply. Please ask your questions using the Q&A function and feel free to use the chat box for anything else. So Brexit happened, but the rules didn't change all at once. UK left the European Union on 31st of January 2020, but they needed a bit of time to negotiate a deal for life afterwards, basically. The talks are happening. I'm sure everybody knows that the talks are happening at the moment. They got till 31st of December, but it does appear that it's all about still Northern Ireland and fishing and fish. But I'm sure Tamara will give us a better insight than that. So, well, Tamara, are you going to get ready to share your slides and we'll get back in? Okay.
There we are. Hopefully you can see my slides now.
Yeah, that's great. Thank you.
Brilliant. Right. So, yeah, as Ian explained, I'm a VAT consultant. I also have some knowledge of duty, though I don't profess to be a duty expert, but I'm learning rapidly because obviously with Brexit, with the transition period and the end of the transition period looming, it's causing a lot of VAT and duty considerations for businesses. And if these are not addressed, then businesses are going to find it really difficult to trade after the 31st of December with the EU. So bear with me. Right, so considerations. Obviously the main consideration at the moment is, and this is kind of gathering momentum to a degree, is will there actually be a trade deal? Up to last week, the answer looked a very firm no, because trade talks seem to have stalled, and it really hasn't been helped by COVID-19 because obviously, you know, the negotiations that would have been entered into face to face previously, that's not happening because of COVID, and also because of COVID, a lot of the EU member states have got other things that are equally important, possibly in their minds more important than brokering a trade deal with the UK. Obviously, if there is a trade deal with the UK, one of the first questions is, will the UK actually stay within the single market using the same VAT accounting rules? And I think the answer to that seems to be increasingly no. The VAT rules are going to change profoundly. Could be surprised, of course, you never know what's going to be pulled out of the hat in this very, very strange year. But it looks to me increasingly like the EU rules and VAT accounting of the EU is going to just change significantly for the UK. So obviously then that begs the question of what do you actually do if you're trading with the EU? And by trading, I mean not just selling to the EU, but actually buying goods and services from the EU as well, because it means there's a lot of new considerations that need to be addressed in order to continue both being VAT compliant, but more practically in actually being able to trade and run your business. So in a perfect world, what we'd really want is a deal where there's no changes to VAT and duty. But that is unfortunately highly unlikely to happen because the UK has already announced it's adopting the world tariff rates. Now, if there's a trade deal with the EU, that might become irrelevant. But in principle, at the moment, we're going to be on the world tariff rates rather than the EU rates. So the EU customs nomenclature that people use at the moment to work out what duty rate applies to goods being imported into the UK will no longer be relevant. Instead, it'll be world tariff rates. And those cause a lot of issues because some of the rates that the UK will be using on world tariff rates to import goods into the UK will be at a different rate to those applying in the EU. So that causes a lot of issues if you then sell on those same goods to the EU market. Because if we have a trade deal where goods can flow seamlessly with no duty between the UK and the EU, potentially from the EU's perspective, you'll have goods in the UK that might have originated from somewhere outside the UK, might be imported into the UK at a lower duty rate, and then sold to the EU duty free. So that means it's likely that the EU would require UK suppliers to be able to prove where the goods originated from. And there's quite complex rules involved in proving origination of goods. And it also means that each trade agreement that the UK enters into, not just with the EU, but with all these other nations that we're now brokering trade deals with because the deals that we had as a member of the EU no longer apply, need to each be studied individually to understand their details. Now, what the UK ideally would want is a trade deal that's similar to the one that Turkey have with the EU. Because if you're in Turkey and you sell goods to the EU, you don't actually have to prove where those goods have come from. You don't have to prove that they're manufactured in Turkey, because that's what origin means, where the goods have been produced. You can just simply say, well, they've come from Turkey. And that's just accepted by the EU. That might not apply going forward for UK goods. UK suppliers may have to prove that the goods have been manufactured in the UK, or some processing has occurred that's sufficient to prove they're manufactured in the UK in order to be able to sell them duty-free to the EU under a trade deal. But at the moment, in principle, it's just going to be duty will be incurred in the UK, world tariff rates, and when goods go to the EU, the customer will incur duty, or somebody will incur duty to clear those goods into the EU, assuming they're dutiable. So what's happening from a UK perspective? Massive changes in terms of how you account for VAT on imports. To be fair to HMRC and the UK government, they've actually been quite pragmatic, and they've introduced a measure which will actually help trade. Not just importing from the EC, but it will help trade in the UK that imports from any country outside the UK, because of this introduction of a new form of VAT accounting called postponed VAT accounting. So at the moment, if you buy goods in the UK that you've imported from outside the EC, you can't recover the import VAT unless you have a form called a C79 form. And the C79 form is your official proof of import VAT. So what happens at the moment is, if you're buying goods, say, from China or India, when the goods hit the UK, somebody, usually the importer, the UK business, has to pay import VAT and duty to clear those goods. And what clearing means is basically customs releasing the goods into the UK, into what they call free circulation. And if that VAT and duty is not paid, the goods sit in customs warehouse, incurring extremely high demurrage charges, storage charges. And at the moment, if you're importing goods from outside the EU, you have to pay that import VAT and duty, and then you have to wait until the VAT return covering the period where you've received the C79 is due, and then you recover the import VAT. So there's always a time lag between you paying the import VAT and you're recovering it through your UK VAT return. Now that all goes from 1st of January 2021. C79s will disappear. They will no longer be issued. And what will happen is, both for non-EU and EU imports of goods, instead of paying VAT at the point the goods come into the UK, you'll have this concept of postponed accounting. And this has changed several times. Originally, there was a system called TPAS that was going to be introduced, which lots of businesses signed up to, and then HMRC went, no, it's unworkable. They got rid of it. Now it's much more simple. What will happen is, instead of paying the import VAT and duty at the point the goods clear into the UK, you'll be giving your freight forwarder or your customs staff, if you do your own clearances, your UK EORI number and VAT number, and those goods will clear, and there'll be no import VAT to pay. Duty will still be payable though. And what will happen is then, when you put in the VAT return for the period covering the month where the goods were imported into the UK, you declare the import VAT on your VAT return and you recover it to the extent you use the goods to make VATable supplies. So say you're, I don't know, Joe Blogg's widget manufacturer, and you're importing goods from China, Germany, France into the UK. 1st of January 2021 onwards, our expectation is, and the system is now geared up, for you to not pay import VAT when the goods come into the UK, and instead you just be declaring the import VAT on your VAT return and recovering the import VAT. So that's a massive cash flow benefit for any business that's an importer of goods into the UK, not just importers from the EU, but importers from outside the EU as well, UK importers that is. And you'd be putting the import VAT in box 1 on your VAT return, recovering it in box 4 to the extent you use the goods for VATable supplies. Net value goes in box 7. So you won't be using the boxes that you use at the moment for acquisitions from the EU. So they'll be used for a different purpose I'll come on to later. So that is actually a side benefit of Brexit, is this facility now to actually postpone accounting for the VAT and recover it at a later date. Although I'm not a duty advisor, something I will say as well is that import duty will be due if the goods are dutiable. Import duty will be due at world tariff rates for any goods coming in to the UK from outside the UK. Now, HMRC are changing the duty system. They're actually changing their IT. They won't be able to implement that change fully until July next year. So what they've said is you can also postpone the duty payment. So you can either pay it at the point the goods clear into the UK, or you can wait up to July 2021 and then pay all the import duty for goods you've imported between January and July 2021 in one go. Some clients have said they'll take up that facility. Others have said, well, no, because we'll end up accruing loads and loads of duty that we'll have to pay at the last minute. So they've said, well, we'll just pay it as we go along as normal. But you have to remember it'll be duty on EU goods as well as non-EU goods, unless, of course, we get some form of trade deal at the last minute. So the other thing that's going to change massively as well is goods coming in from outside the UK that are low value consignments, because there was a low value consignment relief for goods that are imported into UK where the consignment value of £15 or less. I think including postage and packaging, it goes up to 18. That's disappearing 1st of January. That low value import relief will go. And what will happen instead is that that's going to be collected at the point of sale rather than when the goods are imported. So output VAT rather than import VAT will be due on these goods. Businesses who are trading via online marketplaces, if the online marketplace facilitates the sale of the imported goods, it's the online marketplace that will account for the output VAT, not the supplier. This particularly impacts on overseas sellers because, with overseas sellers that are selling direct to UK consumers, they'll be in this odd situation where if their goods are coming into the UK and they're below the low value consignment level, they may be able to declare the VAT. The online marketplace they trade through will declare output VAT on their behalf. So they wouldn't be due, they wouldn't be declaring output VAT. But if they are selling without using an online marketplace, then they would be liable to account for output VAT. So it's going to go. This is the change in ethos now to ensure that VAT is collected on the sale, rather than input VAT being collected when goods are cleared into the UK for low value consignments. And I don't know if there's anybody in the group that are listening that are actually going to be affected, or are actually part of an overseas business that is going to be affected by low value consignment imports. If they are, you really need to study the rules because they're changing so significantly. So what the impact, and if you're a business who's not a UK online marketplace, and there are quite a lot of these now, because I mean the main ones you're familiar with will be like Amazon, eBay, Shopify, people like that. If you're an online marketplace who is facilitating the sale of goods by a seller who's based outside the UK, and the goods are located at the point of sale in the UK, then what will happen is there'll be input VAT and duty being incurred when the goods come into the UK, but when the goods are sold by the online marketplace, it's treated as a seller. You know, even though technically it is somebody who's just trading on that online marketplace who's made the sale. So what would happen is, say typically you're a Chinese business and you're selling goods via Amazon in the UK. Amazon in the UK now will be the person who declares the VAT on the onward sale to UK consumers and customers. But the Chinese business will still have to register for UK VAT, because it will have to account for import VAT and make a zero-rated sale to Amazon or whichever online marketplace is involved. But this doesn't occur apply to business sales where the goods are in the UK at the point of the sale. And that's providing the business recipient gives a valid VAT number to the online marketplace. And that's quite an important point, because I find as a VAT consultant, time and time again, if I'm reviewing clients' VAT accounting, often they have VAT issues around expenses. Say you've got sales reps on the road, or you might have members of staff where you need something really quickly, say a small part or laptop or IT peripheral, something like that. They might go onto Amazon and buy that online just for speed, you know, to get that quick delivery. Now it will be absolutely vital from 1st January 2021 onwards that you give Amazon your UK VAT number, because if it's in a position where they don't have to declare VAT on the sale, you've then ensured that you're correctly accounting for VAT on that purchase. So basically, overseas sellers are going to be in a really odd situation for low value consignments, where they're going to be liable to account for and register and account for VAT on sales to UK end consumers, unless the sales via an online marketplace, in which case the online marketplace will account for the VAT, but the seller will still have a liability to register to account for import VAT. So more practically, from a UK perspective, as I say, the easy bit to a degree, other than if you're selling via an online marketplace, is importing goods into the UK, because providing the paperwork's correct, then you can use postponed accounting. Something I ought to also mention in terms of paperwork being correct is that you need to be quite careful if you're somebody who, say, for example, is bringing goods into the UK from the EU for processing, where you don't take legal ownership of those goods. So if you bring them into the UK to process, then you send them back out to the EU. At the moment, it's not really a problem, because you've got acquisition VAT. You can acquire for it quite easily. There's all rules that allow those goods to move seamlessly in and out of the UK while we're in the EU. Post 31st of December 2020 onwards, if you are a processor where goods come into the UK to process and you don't take legal title to those goods, there'll still be import VAT and duty incurred, but you won't be able to recover that import VAT because you're not taking legal title to those goods. And in those circumstances, it is likely that your EU customer will have to register and account for the import VAT and account for the goods moving back out to the EU, which unfortunately is likely to make UK processors not that popular in terms of dealing with for EU businesses. So the bit that I think will potentially cause a lot more headaches for UK businesses, and it's certainly one that I'm advising a lot of businesses about at the moment, is where you're selling goods to the EU market. You know, so your customer base is businesses in the EU or consumers in the EU, because this is going to change profoundly now. And this is the area that's going to really hit businesses. Because from 1st of January 2021 onwards, if you're selling goods on any terms other than delivered, duty paid, particularly if you or ex works, you, the UK business, will make the customs declaration, or you're expected to make the customs declaration when the goods are exported outside the UK, which is something you don't do at the moment because obviously it's just a movement of goods through the EU at the moment. What will happen is that you can either make the declaration, or your courier, freight forwarder, or customs agent can make the declaration, and those goods will be an export, so zero rated for UK VAT. So in that sense, that's quite simple because you're simply treating it the same way you would an export to any country that's not part of the EU at the moment, just be zero rated. But the problem comes when your goods get to the EU border, because to get those goods released into free circulation in the EU, because we're no longer part of the single market, somebody has got to pay the import VAT and duty in the EU. Now, it's quite easy to take the simplistic view that that somebody should be your customer. But if your customer's not aware they're going to incur import VAT and duty when they've bought goods from you in the UK and they've come into the EU, they're likely, one, not to be very happy. Two, they might not actually be able to pay at the time because the cash flow might not allow them. And three, they simply might not want to pay. And the problem is there, if nobody's took ownership of who's going to pay the import VAT and duty and clear the goods into the EU, those goods will just sit on the dock or at an airport somewhere in the EU with them not actually being delivered to the customer, and the customer's unlikely to pay in those circumstances for the supply of the goods that you've made to them because they've not got the goods. So you need to think about this now, really. Who is actually going to deal with imports into the EU? If the sales below the low value import scheme, you need to be set up to make your export declaration. But you need to be thinking now, are you going to be the person who's absorbing the VAT costs when goods clear into the EU? Or is it going to be a customer? And if you haven't considered that, and your customer hasn't considered that, you're going to have a problem, potentially 1st of January onwards. Now, the other problem that is facing a lot of businesses is what's called Incoterms. Now, Incoterms, I kind of knew they existed in the past, but didn't really take much heed of them. Incoterms are the contract terms and the terms used by freight forwarders that determine who's actually going to deal with import VAT declarations, export declarations, etc. Now, X works. You're just selling the goods and your customer's responsible for the export declaration and the import declaration into their country. Delivered at place, DAP, you're responsible for the export declaration and the customer deals with the import declaration in their country. Delivered duty paid, which is a very common Incoterm DAP, DDP, you are both responsible for the export declaration from the UK and you're responsible for the import declaration when goods reach the EU. Lots of my clients have got contract terms at a DDP, and it's never really mattered well part of the single market, because the goods are just dispatched from the UK zero-rated, acquired in the EU, and the customer accounts the acquisition, business customer accounts the acquisition tax on their VAT return. That will go, because what will happen is under DDP terms, you'll have to do the export declaration from the UK, or your UK business will. And when the import VAT comes in, when the goods get into the EU, you're also responsible for clearing those goods and paying import VAT and duty. So what you need to be thinking about now is, have you got contract terms at a DDP? If you have, can you amend them so there's something like Ex Works or DAP? If you can't amend them, then you're going to have to think seriously about how you deal with the VAT that's going to be incurred in the EU, because suddenly you've got an additional cost to exporting your goods, because you've got VAT that you're incurring in the EU, and you need to work out whether you're able to recover that VAT if the country where you're clearing the goods allows you to register to recover it, and if so, will you then have to declare VAT on an onward sale? Can your customer recover it and you reimburse them and you just lose that VAT? Or is there any other kind of trade facilitation measure that you can use? And this will vary from EU country to EU country. Now, the issue that we're finding, a lot of clients are finding at the moment, is that particularly if they're dealing with large customers or customers who take up a significant proportion of that client's customer base, is the customers in the EU turning around and going, well, you know what, we didn't actually ask the UK to leave the EU, so why should we incur the import VAT and duty in the EU? Why should we deal with the extra paperwork of clearing goods into the EU? Therefore, we'll only trade with you on delivered duty paid terms. The likes of the big multiples are a good example. Aldi and Lidl. Certainly, some of my clients who sell to the Republic of Ireland are finding that the big multiples like Aldi and Lidl are saying to them, you've got to register an account for Irish VAT, you've got to clear the goods into the Republic of Ireland. Yeah, you can charge us Irish VAT. So really, other than cash flow, there's no benefit to Aldi and Lidl, but they just don't want to handle the paperwork. And that type of EU customer are just turning around to UK business and saying, you either deal with the import VAT in the EU for us, or we find another supplier. So if you haven't considered this now, you really, really need to think about it, because it has the ability to have a profound impact on the profit you achieve on your sales. This does make me sound, I realise, a bit like the voice of doom. It will be possible to continue trading very successfully with the EU if you're a UK supplier. But you need to have thought about this first. If you haven't thought about it first, you're going to really struggle next year. Particularly in things like clearing goods and export declarations and clearing goods into the EU, because we know that some member states have already said that they will go out of their way to be awkward. France, for example, have already said that unless all the documentation is absolutely perfect when goods reach France, they won't let UK goods off the dockyard. And they've made that is their policy. Germany, similar. Netherlands are a bit more helpful because they've set themselves up specifically to be an EU trade hub, with goods coming in from outside the EU. So they're already kind of geared up for a lot of this. But you need to think about it now, because otherwise, if you're selling goods that are going from the UK at the end of this year and reaching the EU start of January, you may find your goods don't actually get anywhere. So, assuming you're going to have to clear goods into the EU because your customers have put the onus on you as a UK business, it's really sensible to consider which country to clear goods into in the EU. Some countries I mentioned earlier, Netherlands, Belgium, set up specifically, they hold themselves out to be EU trading hubs. So Netherlands, for example, have got the same concept of postponed import VAT accounting that we have. So those countries would be the ones I'd always say, you know, if you're going to have to clear goods into the EU, those would be my countries of choice to clear the goods into. Not always as easy as that, because obviously you've got to get the goods to the Netherlands, and they might then be going somewhere else. You know, in some cases you might find it's easy, you know, that you've got to weigh up the transport costs of where the goods are going as well. Now, some EU countries allow non-established businesses, and non-established businesses means you're not established in the EU. Some EU countries allow non-established businesses to VAT register, you know, without having any liability that automatically makes them registrable. Others actually require an establishment of some form to actually be set up in their country to allow you to trade. And some of us also require a business owner to be located in their country. So again, it's a case that you need to look at which countries you're trading with and have a think about what you need to do if you're clearing goods into those countries to be compliant with their rules. Now, as I said, Netherlands have a similar concept to us as postponed VAT accounting. So in Netherlands, you can register. My understanding, I will say, I'm not a Dutch VAT expert. So if you were seeking registration in the Netherlands, you'd need to speak to a Dutch VAT advisor. But my understanding is in the Netherlands, for example, you can register as a non-established business. You can have an agent who submits your VAT returns, use postponed accounting, and then you just have dispatches from the Netherlands to other EU countries of goods that are coming into the Netherlands, zero rated. They also have an internal reverse charge as well. So you can end up in quite a good situation if you're sending goods via that country. Other EU countries don't have the same rules. In fact, although at the moment we're supposed to be part of this harmonised single market, the rules do actually differ country to country. So, for example, some EU countries don't ever reimburse you VAT claims. So Spain, for example, my understanding is that you could clear goods in Spain, incur import VAT, which you'd have to pay to clear the goods, sell the goods onto another customer in a third country to Spain, say Portugal. So you're in a VAT repayment position. Now, if you were in the UK, you'd be able to get that VAT paid back to you by the UK tax authority. My understanding is in Spain that doesn't happen. You actually get offset against future liabilities. So it's quite, so it's quite dangerous if you're trading in the EU to assume that the goods are the same. That the VAT rules are the same in each EU country. And Peter Bennett has asked, how do you find out the country's clearing trade rules? The way of finding that out really is you've got several options. You can ask somebody like myself, and I can find out the information. And I would probably have to refer to somebody in another EC member state. Our firm deals with an international, what's called International Tax Representatives Group, and they have VAT advisors in various different EU countries, but they don't have advisors in every country. You can use, there's a number of VAT compliance businesses who are set up to do international VAT compliance, and they can also assist, obviously for a fee. The other options are probably things like e-chambers of commerce, and also embassies. So I've got a client, for example, at the moment in Greece, and I've registered them for UK VAT because they're going to be sending goods to the UK. So they needed an UK URI number and a UK VAT number to account for their sales. And Greece, unfortunately, is in a very poor economic state. What they've done is they've actually taken information from the British Embassy, although they're a Greek business, because British Embassy wants Greece to continue being able to trade with the UK. They've got information from their embassy. And I think what they'll probably do is just ask me to sense check their understanding. So there are lots of different ways of finding this out. You can also go on, obviously, joys of the internet, you can go on each member state's own website and try and work out the VAT rules from that. So you've got various options. I mean, obviously, me being a consultant, I'd always say use a consultant, but I think, you know, you ought to bear in mind that there are other sources of information. If you bear with me, because my slides just ground to help. Yeah, so the other thing that's going to profoundly change again post-Brexit is triangulation for EU businesses and UK businesses. This is a trade simplification. It often has people scratching their heads, but it works quite simply, and it's been very beneficial to UK and EU businesses, whether trading UK to EU and the third EU countries involved. Triangulation is a mechanism that allows free EC businesses who are each in different member states to avoid having to register in various member states. So they only have to register in their own member state. And my example here, if you're a UK business and you've got a contract to supply a customer in another EC member state, but you're supplying goods to that customer in another member state that you're buying from a third EC member state, what you can do at the moment is you can contract with your supplier in one member state. That supplier will not charge you EU VAT. He will zero rate his supply using your UK VAT number to support him zero rating. He'll send the goods to another EC country where your business customer is based, and you will invoice your business customer free from UK VAT and free from EC VAT using your business customer's VAT number. And then the business customer accounts for acquisition VAT when he receives the goods in his country. So the goods flow seamlessly across the EU with the customer just accounting for VAT on the acquisition. So post 31st of December, that goes because we're no longer an EU country. So what will happen instead is that if you're in one of these triangular chains of transactions, when you purchase your goods from an EU supplier in one country and ask the EU supplier to send them to another country, your EU supplier has a problem because he can't zero rate his supply to you anymore because the goods aren't exports, they're not leaving the EU, so he can't zero rate on that basis. You can't give him your EU VAT number because you're not part of the EU anymore. So that supplier has to charge you VAT in his country. He's got no choice in the matter. And then you've got to think, well, can you recover the VAT in that country? The actual logical answer to this is you would actually have to register for VAT in the country where your other EU customer is based, recover acquisition VAT, and then charge VAT on the onward supply to your end customer in the third EU country. So example, UK, top of the triangle, France, bottom of the triangle, Germany. In the past, you'd use triangulation to UK business, no VAT incurred, no VAT charged. Your customer in Germany accounts for VAT on acquisition. These are business-to-business transactions. Now, post 31st of December, your French supplier has to charge you French VAT because you've got no EC VAT number. And you probably can't recover that VAT. Your only option then is to actually register VAT in Germany to account for the acquisition and charge VAT on your onward supply to your German customer, providing, of course, the German tax authority allow you to register. And that's an additional compliance cost then to your business. Or you just incur a recoverable VAT in France, which will increase your costs then and reduce your profit. And Northern Ireland, the main issues at the moment, as mentioned, I think at the start of this, were fisheries and the Northern Ireland backstop, the treaty. And that's causing some significant headaches from a VAT viewpoint, because obviously we're leaving the EU. Northern Ireland is supposed to be also leaving the EU with us, because it's still part of the UK. Unfortunately, the EU and this backstop agreement cause a real complexity, because you've kind of got Northern Ireland is going to be both in and outside of the EU at one and the same time. And Now, HMRC have very, very recently published guidance on what will happen. The guidance is a little bit sketchy, but it does actually set out what their expectation is. So what will happen is, if you're a business that's based on the UK mainland, so say, I don't know, you're based in Wiltshire, and you sell goods to a business customer in Northern Ireland, you'll just charge UK VAT as normal. So that's fine so far, no change. And it's the same if you're selling to a non-business customer in Northern Ireland, and the goods going from the UK mainland, just charge UK VAT because it's UK to UK transaction. The issues come and the complexities come, say you're moving your own goods from the UK mainland to Northern Ireland. So although it's just moving goods within the UK, within the UK, you will actually have to account for VAT on your VAT return on a deemed supply of those goods, almost like you're moving goods from the UK to the EC. So suddenly Northern Ireland becomes almost like an EU country. So say you move your own goods to be processed in Northern Ireland, you're expected to account for VAT on the movement of those goods. You declare it as output VAT and then you recover it as input VAT. So effectively it's creating a VAT obligation, an extra reporting requirement for goods moved, for your own goods moving to Northern Ireland. Now, the other complications come around things like triangulation. So if you've got goods in Northern Ireland that are coming in to Northern Ireland from the EU, you'll be able to treat those as acquisitions if you're UK VAT registered, even though Northern Ireland's part of the UK and it's left the EU. You'd actually be able to use EU VAT accounting rules. These are goods that are purely going from, say, France to direct to Northern Ireland, being held in Northern Ireland. And you can also treat sales of goods to EU customers where the goods are held in Northern Ireland at the time of supply under the normal EU VAT rules. So you've got this additional complication. I've actually been looking at this because one of my clients is trading with Republic of Ireland, and some of the goods go via Northern Ireland, and it will be a lot easier for them to actually store those goods and sell them to the Republic of Ireland, customers in the Republic of Ireland, and just treat them as normal EU transactions rather than having to register VAT in the Republic of Ireland, which is what will happen if the goods go from the UK to the Republic of Ireland. My customers clear in the Republic of Ireland. So yes, so you've got this weird hybrid system that's going to occur for transactions with Northern Ireland, where if it's just you're just simply selling goods from the UK to Northern Ireland, UK normal VAT rules, normal UK VAT rules apply plus UK VAT. If you're storing those goods in Northern Ireland, you're moving your own goods to Northern Ireland, or you're selling goods that are in Northern Ireland at the time of the sale, and they're going to the EU or coming in from the EU, you're actually going to be using normal EU VAT accounting rules. And things like margin scheme supplies, second-hand margin scheme goods. Once we leave the EU, the second-hand margin scheme is an EU VAT rule. And what that means is, if you're dealing with second-hand margin scheme goods, say cars are the good example, or we were talking earlier, so I'm a horse person, horses fall under second-hand margin scheme, computer discs, games, second-hand margin scheme. At the moment, if you're a UK business, you buy in second-hand margin scheme goods. Those goods can be accounted for under the margin scheme. You sell them on under the margin scheme. Once we leave the EU, you buy goods that are in the margin scheme from an EU supplier. You have to import those goods, incur import VAT. You have to sell them plus VAT on the full selling price. And this will cause issues with things like goods going between UK and Republic of Ireland. But my understanding is, if those cars, say for example cars, if they're in Northern Ireland at the time they're sold, go to Republic of Ireland, they'll stay within the margin scheme. So it's going to become a real headache, I think, for any businesses who've got a Northern Ireland establishment or are sending goods to Northern Ireland that they retain ownership of. Oops. Now, the other big impact on UK businesses is distance sales, and I don't know if anybody here listening to this is familiar with distance sales, but again, it's a trade facilitation measure, kind of. Is what happens is with distance sales, if you're in the UK and you're selling to consumers in EC member states, you register for VAT in those member states if your sales go over certain thresholds, and you account for VAT in that member state. There's no import VAT. That's the current rule. Come 31st of December, anybody with distance sales registrations in the EU or selling to EU consumers and just charging UK VAT won't be able to do that anymore because they're going to be exporting the goods. So the distance sales registrations will all be cancelled, so no longer be valid. And any of your UK supplies will become export zero rated. So that sounds great because suddenly you're not charging your consumers in the EU VAT. But the problem comes, like a client I was talking to yesterday, the problem comes where the goods reach the EC, because suddenly your EC consumer is faced with having to pay import VAT and duty in order to clear the goods into the EU. If they're not aware of that, they might not be happy to pay it. And even if they are aware of it, they might not pay it anyway. And then you'll have goods that are sitting in transit somewhere uncleared, not reach the end consumer. Or you might have consumers like one of my clients, their website, when you log on, you click on, you put in the country, you get the information about postage costs, and then you charge VAT and the VAT's added on. In those circumstances, the client's having to think, well, how do we deal with the import VAT? Will we have our freight forwarder pay it? Because really, it's not going to change the amount they charge in the customer. They charge, say, for example, they charge £100 on goods. The client always deducts the VAT at the applicable rate for the country where the customer is based, and pays it to the tax authority via the distance sales registration. So really, it's no different for them if they just charge £100 and swallow the VAT cost when they clear the goods into the EU. But doing that means that my client then has to have a freight forwarder clearing the goods. And it's going to add on £5.70 per consignment in additional cost to clear those goods into the EU, never mind the import VAT and duty. But this is for a short period of time. Anything that falls below the low value consignment relief rate, which in the EU I think is €22, will still continue to clear in VAT import VAT and duty free post 31st of December. Anything above that level will be import VAT and duty incurred. Then it all changes again, nothing to do with Brexit because this was happening anyway. 1st July 2021, the EU is bringing in what's called the one-stop shop. There's going to be a one-stop shop for imports throughout the EU. And the options there will be either use a freight forwarder to clear the goods and pay the import VAT and duty on your behalf, which becomes an irrecoverable cost, or you sign up to this one-stop shop, you choose an EU country that you find easy to deal with, so probably Republic of Ireland, because this is the reason why Amazon, for example, is VAT registered in Republic of Ireland. You find it to speak English in Ireland, makes it easy to deal with the tax authority. You'd have to register for VAT, choose an EU country to register and sign up for this one-stop shop and declare VAT at the VAT rate applicable in each EU country where you're selling goods to the end consumer. So it'll be like distance sales. So there'll be this strange interim period of 6 months where if you're selling to end consumers in the EU, somebody has got to deal with that import VAT and duty. And if your end consumer's not expecting the import VAT and duty charge or not willing to pay it, you're going to have goods sat, just floating around somewhere. And that sale will fall over. So this is something else. If you're selling to end consumers in the EU, or have businesses who do that, you need to think about it now. Yeah, so and services as well will also be profoundly affected, because what will happen is if you're selling services to end consumers in EU countries, your EU VAT registrations will cease to be valid 31st of December. But you can sign up to the non-union version of VATMOS. If you don't do that, then technically you're liable to register an account for VAT in each EU country where you've got a customer who's an end consumer, where you're selling them digital services. So that's things like, selling apps. But again, that changes again 1st of July, because this one-stop shop also captures suppliers in the UK who are making supplies of digital services or any other services to EU end consumers. Because what will happen there is, if you're providing a service to an EU end consumer, no matter whether it's digital service or any other kind of service, you will actually have to sign up for a one-stop shop and account for VAT on the onward supply to your customer. Like I say, and that'll be it's very similar to the VATMOS system. At the moment, I can't give you more details because that is literally the level of detail that's been published by the EU. So we know it's coming in, but full details aren't yet available. And that again is because of COVID, because it is delayed them bringing in all the finer details about implementing this system. Example of somebody who'll catch, I've got a client who's basically is an astrologer, and he provides his services to lots of consumers, including ones in the EU. He'll be caught by this system. Although he supplies his services over using YouTube, he's not supplying digital services because every single thing he does is bespoke for each individual customer. But from 1st of July 2021, he'll have to sign up and account for VATMOS on his supplies to consumers in the EU. So, coming to a short summary of what is a massive issue, and I think a bit, like I say, it's one, providing you think about it and you've put measures in place, yes, it's going to impact on your business. Yes, it's going to change how your business trades with the EU, unless we have this miracle unicorn trade deal and everything stays the same as it is at the moment. It does have the ability, it has a really strong possibility of really damaging UK businesses, but mainly the ones who haven't considered it, haven't considered the impact. If you have considered the impact and put measures in place, then your business with the EU should still be able to continue. But what worries me as a VAT consultant is I'm doing a lot of Brexit planning advice, and as a firm we've been doing a lot of Brexit planning advice for clients. The majority of the ones that our customs team have been dealing with are quite big businesses, multinationals and so on. The majority of the ones I've been dealing with have been EU businesses trying to get their VAT position straight for when they start trading in the UK when they trade in the UK post 1st of December. I'm only starting to be approached now by UK businesses, and that worries me. Is it not just as a VAT consultant, but as a UK citizen, because it implies that people have waited to the very last minute. And we know already the UK border now is going to be Kent. So if you're sending goods outside the UK, if you haven't considered all this, worked out who's going to clear the goods, who's going to do the export declaration, who's going to do the import declaration when the goods get to the EU, you've got a big backlog of goods sitting on the edge of Kent, not going anywhere, and your customers are not going to pay you if you don't receive the goods. So you need to be thinking about it now. If there's a trade deal, great. Although I think the VAT accounting systems will change, but you would always hope to get a trade deal where, perhaps the EU just allows goods to move seamlessly. I suspect that won't happen though. Because from the EU perspective, they don't want to make life easy for a country leaving the EU. So if they make the life easy, and this is my political, own personal opinion, not the opinion of the firm I work for, but if the EU makes life easy for a country exiting the EU, you know what? There'll be a lot of other countries that'll leave. So they will make it difficult because otherwise it's not in the EU's interest to do that, to to help. Why would they? Because it would just help it break up the EU even more quickly. So UK businesses, you can cushion the impact significantly by ensuring that goods can exit the UK ports from 31st of December. That means the export declaration done by you or your customer needs to be correct, and you need to have thought well in advance who's going to do that declaration. Make sure your system's set up so that the goods are actually clearing going outside the UK to the EU. You need to think about who's going to deal with the import VAT when your goods reach the EU. Is it going to be you? Is it going to be your customer? Are you certain if it's your customer that they genuinely are going to clear those goods? Because you don't want to get into a row with who's responsible for demurrage costs and import VAT and duty.
Okay, Tamara, I think I'm going to have to stop you there because I need to, just get a little bit of discussion going, if that's all right.
Yeah, sorry.
No, it's great to hear your views on all that, but I sort of, if we can bring in some other views as well, that would be terrific. Because you're obviously very knowledgeable about your subject, and that is fantastic. And so, we'd like to take advantage of that, if that's okay.
Yeah.
So, Ernie, you've been sitting there, very patient there. Thank you very much. Do you see any particular issues that you think you might just want to raise? No, everything. Yeah.
That's my primary sort of conclusion, which is I'm going to go away after this and have a brain dump and stop exporting. I'm just going to start trading only in the UK, and then my life would stay easy. I think, I had a whole raft of questions really, but a lot orientated around my business. But one that might be of interest to people is some of my co-owners of this business actually live in France.
Yeah.
So, retired to France, but sort of still work down there. In the past, we've looked at, is it worth us having a European sales office then? Because that will simplify things. And people have always said to me, well, actually, there's no real benefit. We're in the EU because we do a lot of business in Scandinavia and in ERA. Does that logic now change where it might be worth setting up an office down in France or a virtual office down in France? And if we do that, you said something about you have to be established. Does that mean we literally just have to have an address, but I can still be Medicare systems down there? Or do I need to actually set up a French company that's like Medicare brackets France, whatever, SA or whatever it is?
Yeah, what you could do in those circumstances, some countries, and I don't know what France's concept is of an establishment. Some EU countries allow literally, brass plate, and that's enough to be on a door, and that's enough to be established. Others require sufficient human and technical resources to transact business. So that means basically somebody in another EU country being able to conclude a contract with your customers. But if you're doing that, if you've got enough to be able to set up a branch in France or a separate company in France, then you've got the potential then to use that to import goods into France. So you'd probably be looking at, say, for example, selling to the French business and it making the onward supply. Because in the EU, the only person who can recover import VAT is the person those goods belong to. So things like what they call toll processing businesses, for example, even if they pay import VAT to get goods they're going to process into the EU, they can't recover that VAT. So there you'd need a French VAT advisor really to look at that properly for you as well, to be able to explain what the French rules are and French implications.
Okay, and would we be able to do what you were sort of saying with triangulation, where, frankly, we just send the goods from Poole direct to Dublin, but, effectively do a paper transaction with France and then France bill Dublin?
No, because the goods are in the UK. The goods would have to go to France. To use triangulation, the goods have to remain within the EU. And the problem is you'd have to you still be exporting the goods from the UK, so somebody would incur import VAT to clear those goods into.
No, I mean I get that. I'm really talking about the physical practicality. So could I be going, right? Well, then I'm selling the goods to France, but as it happens, I'm storing them here for now. So we'll pay the import duty and things like that, and then France sell it to Dublin, and then Dublin say, okay, we'll call it down from the French store that happens to be in Poole. Do you see what I mean?
Yeah, but you'd still get import VAT because the goods are going from the UK to Republic of Ireland, so there still be import VAT in the Republic of Ireland.
Right. Okay. So really, unless I'm physically moving, what I'm saying is if I put stuff in a box, are you saying then I literally have to move the box into France and then move the box from France into Ireland?
Yeah, or register for VAT in Ireland if you're going to clear the goods, or ensure your customers willing to clear the goods into Ireland.
Okay.
So those are your options, really.
Right.
The thing you've got to remember is if the goods are in free circulation in the UK, then as soon as they leave the UK, they're being exported from the UK. If they go into the EU, to any EU country, they're then going to be an import into the EU.
Yeah.
It does sound like there might be a lot of cases where for actually to have an establishment, like you said, in Holland or Belgium. I mean, I know we have several clients who've already done that. But it means paying somebody to do that.
Yeah.
Costs are going to go up. Yeah.
Yeah, and this is one of the big worries for me. Is, as I say, I think a lot of UK businesses, unfortunately, have left it a little bit late. Somebody on the question and answer has said, why haven't we got more information about this? What the rules are like? To be fair to HMRC, the information that I'm delivering on the UK VAT side of it, that has been available at least since September, if not before.
I think the reason for that is if the question is like I am, I also export to New Zealand and several African countries, and I export to California. So from my perspective, I just thought, well, it's just a different export. Instead of me exporting to New Zealand and putting Christchurch, New Zealand on the sticker, I'm going to put Dublin, Ireland on the sticker. Yeah. I just treat them now as a foreign country, not a European country, if you see what I mean. If that's and that's why I've not really ramped up. But I think probably the difference is from what you're saying is that the people in Ireland that I'm selling to probably aren't thinking about import duty either or VAT either, because up until now it's just been going cross-border, whereas the New Zealand customer, he does pay the duty as it goes into New Zealand and the VAT as it goes into New Zealand.
Yeah.
And it's probably actually getting the European customers to understand that actually from my perspective, they've got a problem, but they might, as you said earlier, turn around and go, well, I don't give a bugger, you sort it out.
Yeah, exactly. I mean, and this has been the disappointing thing, really, with clients where they're dealing with some of the bigger multiples, where that customer could, no problem at all, would be able to recover the import VAT and the duty when goods clear into the EU. The only extra cost to the customer would be maybe the duty, and obviously processing the import declaration. But in reality, other than being, pure bloody mindedness, there's no reason for those customers not to deal with the import VAT because they'll be able to recover it in full.
In the same way that we pay the VAT when it's coming.
Yeah. Same way as New
Zealand. Screens inbound and we pay the VAT and then recover it when we sell the product.
Yeah, and for those where you're selling B2B to EU customers, in a lot of cases, other than cash flow and doing the export, the import declaration, there's no actual extra cost to the customer. And you want ideally to make sure now that your customers are just going to be aware that they're going to incur import VAT Or you could leave them to find out, but I'd be worried about leaving them to find out in case your goods then don't get cleared.
No, indeed. And also to make sure that our sales people look out for DDP.
Yeah. Yeah.
You know, if they see that, they're to, you know, sort of, well, have a brain dump as well and then come and tell me or whatever, because that effectively means they're shoveling it onto us, doesn't it? Just using that term.
Yeah, and you think some of your EU customers may not have even considered this.
No.
You know, and so they'd get a shock as well. So it kind of makes sense, you know, if you want to keep trading with the EU, make sure everybody's aware of how this will change. I think the biggest impacts for consumers. I think there was a gentleman who was trying to ask a question but wasn't able to get on the Q&A.
Can you hear me?
Yes, I can hear you now. Yeah.
Hello, Brian. Welcome, Brian.
Sorry, I missed the start of this, but interesting enough, there's earlier on you talked about EORI numbers.
Yeah.
We've had an instant. This is just to let the panelists know. We've had an instance yesterday where we were trying to bring some stuff out of Switzerland back into France, and they demanded our EORI number, which we've registered and got validated everywhere, both our French one and our English one, and neither of them could be recognised on the European system.
Oh, strange.
It's taken us 2 days to get it resolved, having got printouts from customs websites of the validation and everything else. The French system would not acknowledge our EORI number, which they wanted. So
strange. So that's your European EORI number or your UK one?
Both. We've got, France doesn't have an EORI number as such. They've got a different system, but our English one was not acceptable. They would not. The system wouldn't accept it. I don't know what. I'm waiting to find out what the agent did to get it through the customs computer system. I haven't resolved that yet. But going back to a question on VAT on services that I do. I mean, I do a lot of European transport movements for a French company currently, where we use a reverse charge system. Question I have is how will that be handled post December, where we zero rate we don't charge any VAT to our foreign customer in France for domestic transport that we do in France, and we arrange it here in the UK, but we work in France and do all the transport internally. At the moment, we reverse charge and zero rate our French customer.
Are you French VAT registered then?
No.
I know they have an internal domestic reverse charge in France. So I'm not sure whether it's falling within that or whether because you're a non-French supplier, it's allowed to be reverse charged in France. I mean, going forward, my expectation would be that if the freight forwarding was going from, say, the UK to France, that it'd be part of an international movement.
That I understand, and obviously customs clearance. I mean, we would have to arrange customs clearance for the goods, but if I'm just arranging transport only from UK into France, as an example, going forward in next year, whereas at the moment we don't charge VAT to our customer, what's the scenario when we leave the EU?
Well, my understanding there is if your service is that of you're moving the goods, so it's freight transport, that would still be zero rated with your customer accounting for the reverse charge. That's how I expect it to work.
Okay. Is that all right, Brian? Okay, can't hear Brian now, I think. But okay. Can we hear you, Brian? No. All right. Well, thanks very much. Have you got any more to add, Ernie, or else we're going to have to wrap up the session, I think.
No, well, probably best to wrap up, but I do think, I've left it late, so I'm going to run around like a headless chicken, but I think everybody else should do as well. If only just get comfort that, you've sorted it. I guess the real thing to do is, if you only trade in a limited number of places, get a mechanical system and go, look, when I'm trading with Dublin, what should I do? When I'm dealing with Denmark, what should I do? And maybe have 2 or 3 processes, just add it to your processes and thinking, maybe is the simplistic way, because it's not as simple as it's just a different New Zealand.
Exactly.
It's a difficult New Zealand.
Okay. Well, no, thanks, Ernie, for joining us. I really appreciate that. I mean, as a firm, obviously, we have lots of contacts worldwide, but and who can help in France and Holland, and obviously, if you need to, set up foreign, what do you call them? Not entities necessarily.
Yeah, establishments or branches.
That's it, establishments. That's the word, isn't it? Anyway, no, thanks very much. I think probably the best thing would be for us to reconvene in the new year and see how things have panned out after the trade deals, and see if we can, perhaps deal with any issues that have arisen that nobody's been able to sort of resolve or found, or let's talk about some common issues.
Yes.
Is that okay? So that's what we'll do.
Sounds good.
Yeah, thank you for your time, everybody, as well.
Thank you, Tamara. I know it's been a bit long.
He's had to stop me, unfortunately, so apologies for that.
No, we appreciate it. I feel we're putting your slides up on the website, I think. And
brilliant.
Thank you very much, Tamara.
Okay, thank you.
Thank you very much.
Bye.
Thank you.
Thank you.
Okay, so in terms of the series of WG Hub Live, we've come to the end of this this series as we're running up to Christmas now. But as I said, I think it looks like we've got plenty to talk about in the new year. So we'll give you some good notice about when we're restarting, but I suspect it will be sometime in mid-January. But thank you very much for joining us today, and keep well, and indeed have a very happy Christmas.